There's definitely some more positive psychology building. And look, you've been talking about it all morning. Part of it is sort of resolving this uncertainty surrounding Brexit. And what we know now that we didn't know at the beginning of the week is that there isn't going to be an imminent hard Brexit, a no-deal Brexit. And that's got markets feeling a lot better.
So we've focused a little bit less on trade recently for good reason. Talks are still going. Brexit's front and center. But the Fed has also been a huge factor in this discussion as well. Are we due for higher interest rates this year?
Well, so the paradox is the Fed's pulling back from hiking at the short end is actually likely to boost the longer end of yields. And we think actually you're going to see higher 10-year yields. But it's really sort of an all-in idea.
But, Julian, there is no inflation out there. We've been seeing all of this data that shows inflation is rather tepid. So what is the case for higher rates if there is no fear of real hypergrowth or inflation out there?
Well, there may be no inflation in terms of some of the backward-looking data. But the fact is that inflation expectations, along with the equity markets, and really in part they sort of fed off each other, have all turned higher. And if you look at Washington, whether it's the Fed going easier and actually probably, in our view, about to curtail the balance sheet roll-off, or expanding the government deficit, or some of these new social programs, there are reasons to expect that inflation is going to come back. And part of that story is also China reflating, we think will be successful, and resolving Brexit.
So the simplistic view on this from my end, just covering markets now, is that higher rates generally means good for the banks. So
yes.
Is it good for the banks?
It is good for the banks. The banks, because of all the global growth fears and you know, again, in particular, this notion that the European financial system might be under attack because of Brexit and these goings on, the banks have suffered disproportionately, and that's translated into a very flat yield curve. We think that pressure could be alleviated in the weeks and months to come, and that's good for banks.
Just a few moments here. Is it regional banks or money centers the best view in your mind?
Yes and yes. Actually, you know, in terms of pure liquidity, we'd say the money centers. They've been punished disproportionately, but they're both going to work if we're right in our thoughts.